Hello my colleagues, in today's video we are going to be taking a look at 5 things you need to look out for when trading stock indices. As most of you know, I started a series earlier this year on the YouTube channel on indices trading, and all thanks to Vantage Market for sponsoring this series and this video. Vantage Market is an all-in-one trading application that allows you to trade indices like a pro with low spreads and leverage as high as 1,000 to 1. Once more, thanks to them, and without much talk, let's jump right into the video. Let's go. For those who might be coming across my video in this series for the first time, so far in the series we have covered what trading indices is all about. And in a particular video that I made, I explained that indices are basically benchmark, or you can say a tool that is used to know how a particular sector or economy is performing. In fact, you can click on the card above to go watch the video where I go in depth on the fundamentals of trading indices. I've also covered the best trading hours for indices and how to leverage indicators when trading indices. You can click on the card above to go watch the video where I go in depth into trading hours. But while those other videos contains details to aid you in your indices trading journey, there are still some additional details which would actually help and give you an advantage over other traders when trading indices, and that is what we are going to be covering in this particular video. So jumping in right away, the first one is familiarize yourself with trading hours. Remember, I have actually made a dedicated video on this before, but to tell you how important trading hours is, it is actually number one in this video again. Familiarizing yourself with specific trading hours is necessary for you to be able to capitalize on peak market activity and ensure higher liquidity. Different indices have distinct trading hours, aligning with the major financial markets they represent. For example, the S&P 500 trades during the New York Stock Exchange hours, while the Nikkei 225 aligns with the Tokyo Stock Exchange. So being able to know when a particular stock market is open and most active will aid you in finding the best trading opportunities. Next up, we have research historical performance data. You see, historical data acts as a treasure trove containing a wealth of information about past index movements. It provides a comprehensive record of price action, trend, and market behavior over time. So analyzing historical data allows you as an indices trader to identify recurring patterns and trend in an index movement. These patterns may include seasonal trends, cyclical fluctuations, or long-term trends, which can offer valuable insight into future market behavior. Now, while historical data doesn't guarantee future performance, it can provide valuable clues and insights that you as a trader can use to anticipate potential market movement. By recognizing patterns and understanding historical reactions to similar events, you can make more educated predictions about future price movements. Historical data also plays a crucial role in risk management. By understanding how indices have reacted to past market downturns or volatility spikes, you can better prepare yourself and implement risk management strategies to protect your investments. Diversification is a cornerstone principle of investment management, and it holds immense importance in index trading. By prioritizing diversification in your portfolio, you can effectively manage risk and optimize returns across various market sectors and asset classes. When it comes to diversification, it involves you spreading investment across different indices, each representing distinct market sectors, industries, or geographic regions. By allocating capital to multiple indices, traders can reduce the impact of poor performance in any single investment and create a more resilient portfolio. In fact, here is a deep dive into how diversification benefits you as an indices trader, or you can even say as a trader in general. One is that it mitigates single asset risk. You see, investing solely in one index exposes traders to the specific risk associated with that index, such as sectoral downturns, geopolitical events, or regulatory changes. Diversifying across multiple indices helps spread your risk and minimize the impact of adverse development in any single asset. Two is that it reduces correlation risk. It's important to understand that not all investments move in the same direction. When stocks go down, bonds might go up, and vice versa. By diversifying with asset classes that have a low correlation, you reduce the impact of negative movement in any one area. Finally, diversification enhances portfolio stability by balancing investments across assets with different risk profiles and return potential. Investing in indices with varying levels of volatility, correlation, and growth prospects creates a well-rounded portfolio that can weather market fluctuations more effectively. The fourth thing you need to know when trading indices is the importance of staying informed about relevant news events. I want you to imagine that you are a captain navigating a ship through a stormy sea. To reach your destination safely, you need a reliable radar to track the weather and avoid hazards. Well, in the world of index trading, relevant news events are your radar. Staying informed about these events is crucial because they can significantly impact the movement of indices. I want you to think of it like a domino effect. One piece of news can trigger a chain of reaction, influencing investor sentiments and driving price up or down. So the question is, what kind of news are we talking about? Well, we have economic indicators, or you can say economic news. These include things like unemployment rates, inflation data, and interest rate changes. These reports paint a picture of the overall health of the economy, which can directly impact specific indices. Next, we have earnings reports. You see, when major companies within an index release their earnings reports, investors react based on the company's performance. Strong earnings can boost the index, while weak reports might trigger a sell-off. Another news to look out for is geopolitical events. Global conflict, trade wars, and political instability can all create uncertainty in the market, leading to index fluctuations. Finally, as an indices trader, you need to be on the lookout for regulatory developments. Changes in government policies or regulations can impact specific industries or sectors, which can in turn affect related indices. By staying informed about these news events, you can adapt your trading strategy, identify potential opportunities, and make an informed trading decision. Before we look into the final things you need to know about indices trading, I want to let you know that starting now, Vantage Market is offering a 13% per annum funds growth campaign that runs until January 3rd, 2025. And here's how it works. The step to join this challenge is basically that you need to simply nominate your live trading account, maintain the minimum daily eligible funds, then trade at least 0.5 lots per week, and that's it. You automatically earn daily interest of up to 0.5%, which gets settled every Monday, and that adds up to a potential annual return of 13%. You can find my special promo details in the comment section and the description. And thanks to Vantage Market once again for sponsoring this series, and back to the video. Finally, as an indices trader, you must use leverage wisely. Leverage in index trading is like your balancing pool. Used wisely, it can help you reach greater heights, but a misstep can lead to a significant fall. Leverage trading is essentially borrowing capital from your broker to control a larger position in an index than your initial investment can allow. Think of it like magnifying your buying power. But here's the catch: leverage magnifies both your profits and losses. But the question is, why use leverage? Used strategically, it can amplify your potential returns. Imagine you have a strong conviction about an index growth. Leverage can help you maximize your gains if the market moves in your favor. But remember the risk. Leverage also magnifies your potential losses. A small market movement against your position can lead to significant losses that could wipe out your entire investment. Here's the key though: understanding your risk tolerance is crucial before using leverage. Are you a conservative investor who prioritizes capital preservation, or are you an aggressive trader comfortable with higher risk but potentially higher returns? Choose your leverage levels wisely. Vantage Market offers a range of leverage options, allowing you to tailor your strategy to your risk tolerance and trading goals. If you are able to take note of the 5 information I have shared with you in this video, you will be able to be a more profitable stock indices trader. Do not smash the like button, subscribe to the YouTube channel, and go on to check out my other videos in this series on indices trading, and see you on the next one. Deal.
No one is born a trader. Be reborn a trader. Trade smarter at Vantage.